So we are at one of those rare inflection points where technology, regulation, and geopolitics are colliding simultaneously, and the outcome is going to reshape how money moves around the world. And none of this is theoretical anymore. This is infrastructure. And the four people, and enter in stablecoins in our discussion today, and the four people on this stage are building it, they're moving it, and moving assets around it, and issuing on top of it, and they're keeping it compliant every day. So we have Sergio Mello, Global Head of Stablecoin Solutions at Anchorage Digital, and he's our qualified custodian holding the assets that underpin institutional stablecoin activity. Michael Sholov, he's the CEO and co-founder of Fireblocks, whose infrastructure moves trillions in digital assets across thousands of institutional clients globally. And then we have Nick Van Eck, CEO and co-founder of Agora, and he is designing the next generation of institutional grade stablecoin issuance. And then finally, Edward Woodford, who's the founder and CEO of zerohash, and he's operating the on and off ramps where stablecoins touch the real world. So between them, they sit at the critical layer of the stablecoin stack. So we'll just get into we're going to explore what kind of global financial system they're actually building. So just a general question to kick off the conversation for everyone. Why is this globalization of stablecoins at this tipping point moment? You want to start?
You want to go
or
first?
whoever wants
I
to
go
jump
first?
in.
I mean, it's much better, and we had the Genius Act.
Okay.
I think one thing that I always talk about is, of course, legislation has been helpful, but at the end of the day, we're talking about technology. And one of the things that we talk about is stablecoin-enabled accounts. So, there's effectively anyone with a PayPal account, anyone with a Revolut account, anyone with a Nubank account, anyone with a Gcash account now has access to stablecoins. And so effectively, the way I view that is that we've seen this massive distribution, about 2.5 billion wallets around the world now that can be seamlessly enabled. And effectively, now that you're seeing this distribution similar to the iPhone, where you've distributed all the iPhones, now the application layer has been built. And that's why you're seeing the volumes pick up as well. So that's kind of our thesis. There's lots of drivers, as Michael articulated, but I think one is viewing this more as a technology play and how the technology is being distributed, and we've really started to see that evolution drive up.
Yeah, I would just add that you have the base layer, right, like Fireblocks or Anchorage on the custody side. You have a lot of distribution that's now happened because of that, and enablers like zerohash that enable people to move money from the existing world, right, like fiat accounts, right, or cards, into this on-chain world, and vice versa. And so that's all come together now. You've had years building this up, and now regulation is finally going to really take us to the next step. Because if you think about it, we've all been in crypto for many years, but you still don't even have basic regulation in the United States or accounting for stablecoins. And so there's, regulation is really going to take us to the next level.
Yeah, I agree. It's a convergence of regulation and infrastructure. We can call it technology infrastructure. It's really the same. It's actually an epic moment to be here because we have 4 builders in the industry that are putting together the components that, looking back in 5 years, will demonstrate how technology, regulation together can really re-platform money onto a new rails. And so we will see how this has happened, just like the internet happened, like mobile phones happened, stablecoins happened, and then we will look back and notice how it was not just a moment, but it was the confluence of a lot of components, including us building, including regulation, and including, of course, technology.
Mm-hmm. So I want to touch on regulation in a bit, but Michael Kivalis
Yeah.
had recent news, I believe the slide is up there, about the consortium and addressing the jurisdictional fragmentation, if you want to just walk us through that briefly.
Yeah, so I think Kivalis is quite interesting because I would say it's the first scale consortium outside the US that makes an attempt to issue a proper stablecoin for Europe. As probably people are aware, 99.9 probably % of all the stablecoin flow and volume and the AUC globally is currently denominated in dollars. When you travel outside the US, especially when you talk with central banks and banks, there is a lot of concern around dollarization of economies. The Europeans, Sergio can probably talk about it as a European, right? But yeah, represent Europe here. But the Europeans are, of course, extremely concerned about that. And based on the MiCA regulation, actually, there is a big advantage for the banks to issue stablecoins in Europe. So this concept actually started with, I believe, ING a few years ago. They came up with this idea. It's like, hey, maybe we can do a bank consortium and do a stablecoin, a Euro stablecoin. And then we actually help them kind of bootstrap it and help them with some of the connectivity to the other banks. But eventually right now, I think there are 12 partners, which are all the, I would say pretty important logos, as you can see in the European banking scene. And I think that there was some announcement or some rumors that it's going to be 32 very soon. And look, it's early days. I think that there is a lot of interest in what they are doing. We clearly servicing as both the tokenization engine, so the technology to issue stablecoin, kind of the security to make sure that this is all being orchestrated and distributed in a secure way. But I think that the most exciting thing is that if this is actually going to happen, and we will have proper rails to go in and out from a Euro stablecoin, then I think we actually have a pretty good view on FX markets using stablecoins and really bringing the entire fiat world on-chain globally, right? And not solely US focused.
Great. So moving into institutional adoption and infrastructure, Sergio, with regard to stablecoin infrastructure, how does Anchorage approach custody relationships through its bank-to-bank solutions?
Yeah, look, I'd like to tie this answer to what Michael just said here. The future is with banks coming on-chain, and with the dollar being replatformed onto trillions of dollars of circulating money supply on-chain. This can only happen if those banks are comfortable in transferring and holding billions clips. So we're doing a lot at Anchorage to facilitate that. And first of all, going back to Michael's news and congratulations, we will see more of coalitions of banks and consortiums coming and playing together in the space. Ultimately, stablecoin is a distribution game. So putting together the nodes and the access to gain a critical mass to distribute and circulate stablecoin quickly is the right thing to do. Personally, I've been involved in stablecoin consortiums for the past 5 years. So I'm really a believer in this added value solution. We will see more consortiums of banks coming in the space. Also, early warning services and Zelle had made announcements last year about looking at stablecoin solutions. This is going to be very interesting. Back to your question, it's not just custody, it's a whole suite of services that banks are more comfortable in consuming from another bank. And that's why I'm very happy to see that the licensing that Anchorage Digital has been running with for the past 5 years, the National Trust Bank, provided by the OCC, the National Bank Regulator, is now also being given to other banks. We need all the banks in America to be crypto banks. We want competition. We want crypto not to be considered a different form of money. We want crypto to be money, a better way of money.
Great. Did anyone, or Michael, I wanted to just note, related to this, Fireblocks, you had a Q4 2025 shift where banks, the pipeline officially exceeded the crypto native demand for the first time.
Yeah, I mean, I think that what we're seeing right now in the industry is that, which, I would say that the Fireblocks pipeline is kind of reflecting what we're going to see in the next 6-12 months, because people come to us to buy infrastructure for projects that they're going to do or going to go live in like 6-12 months. So Q4 2025 was the first time in the history, so the company exists for 7 years, 8 years almost, and it was the first time that the pipeline of banks and payment companies exceeded the number of companies that are fintech and crypto native.
Yeah.
First time it's happened. And I think it's something that is, I guess, telling to where the momentum is basically heading.
Mm-hmm. Interesting. The data doesn't lie. So
no,
now,
sometimes lies, but
sometimes. Nick, so looking at emerging market demand, is the explosive demand for dollar stablecoins in these emerging markets a permanent shift in how value moves, or will this demand evaporate if the local monetary politics stabilize?
Yeah,
And are they a permanent, is it a permanent fix or a temporary?
I wouldn't even call it like a permanent shift because it's already happening today, right? So if you look at like the euro dollar market, which are dollar deposits outside of the United States, that's already in the 15 to 20 trillion dollars, right? I would say you're seeing a lot of early consumer adoption of stablecoins because in places like Argentina they were using cash, right? And stablecoins are just a much better vehicle for them to save, store, and grow their wealth, right? And escape local inflation. But if you look at the euro-dollar market today, like that's mostly institutions and business capital, right? So a lot of flows that we see that are in dollars today, but we see changing to stablecoins are things like international payroll, just corporate treasury, B2B payments. Those are already there and they're going to stay there. Right now they happen via SWIFT or traditional rails, but we see that moving to stablecoins because you can now settle instantly, settle cheaper, and earn more on those dollars. And so we're talking to small startups that are doing this, that want a global dollar account, but also Fortune 10 and Fortune 500 businesses that have multi-jurisdictional operations. And so I would say that the demand for dollars globally is already there. It's just moving, from, the fiat system to stablecoins. And to your consumer point, right? It's just a better vehicle. They don't want to have to go to like the local Cueva to, get a, the green or the blue dollar, right? They just want to use stablecoins, and so it's here to stay.
Okay, so Edward, addressing or looking at the friction in current on and off ramp infrastructure, does that current friction in moving between fiat and digital dollars prove that we are truly democratizing access, or are traditional banks successfully just reasserting their roles as gatekeepers?
Yeah, so I think there's a role to play across the landscape. I mean, you can use the term digital dollars, you can use the term on-chain money. Stablecoins are now a very defined term here in the United States. You're also going to have tokenized on-chain deposits, you're going to have tokenized money market funds. At the end of the day, it's all a form of dollars that can interact in different ways. So there's a big debate around whether or not how stablecoin yield or money can work, for example. And even within these categories, there's a whole set of subcategories as well. Within the tokenized money market fund, there's different types of funds that can be treated in different ways, and they serve different purposes. So for example, when you're talking to clearinghouses, they can only accept certain types of money market funds as opposed to others. I think the commonality is the technology, and the important kind of friction points is going to be around interoperability between these aspects. And so this is what we do with groups like BlackRock and Franklin Templeton and others that have tokenized dollars in a money market fund-like construct, and we provide the rails between stablecoins and those tokenized money market funds. So there's going to need to be this greater interoperability that we're helping solve. The second big thing is the usability. So if you think about even the largest stablecoin here in the US, USDC, USDT, there is this massive fragmentation that exists from an on-chain perspective. 30+ chains, which is only going to increase. I think we all agree that there's only going to be more chains in terms of which these assets are listed on. And so the usability friction here, the UX friction is high. And so we're solving that problem as well in terms of, at the end of the day, it should be as simple between me moving money to Michael or us powering groups like Kaush or Interactive Brokers or Gusto. An account-to-account movement is the critical point. This point around users making decisions about chains or even the type of money that sits on top of these chains needs to be abstracted away. So that's our product auth that needs to be solved. So I think there's a place for everyone to play, but as you see this greater fragmentation, both at the asset level and at the chain level, interoperability is key, as well as usability.
Okay. So we just need to get rid of all the labels.
It's money after all, right?
Right.
Yeah.
Okay, so let's talk about regulation. And pivoting away from the US and the EU, and like the Genius Act or MiCA, what are the most significant regulatory developments happening outside of the US and the EU?
I just came from Asia, like 10 days there. So Japan, they had a stablecoin regulation for a few years, actually ahead of the US. But now they're seriously pushing this through and doing some reform. I think Korea is looking to do something this year. It's kind of on the table over there. Australia as well. And maybe like, the most important markets that still need to kind of to evolve is LATAM, specifically Brazil and the entire pack over there, where if you actually like follow the news, I think they're providing CoinDesk a daily, stream of things to write about, feed to write about, yeah.
But I think one point which is important, right? Genius has passed, and that's a great piece of legislation. Two key points. One is rulemaking is still ongoing, and there are things that I think we all agree needs to be implemented in terms of providing safety and soundness around what is ultimately a dollar. Secondly, there's still things that need to be solved within the United States. So for example, it's a pretty nuanced point. It may not be interesting to everybody, but for example, the accounting treatment. In the United States, this really, really matters. So if you're a payments business and you're using USDT and you're effectively acting as in the money flow, that is treated in a gross basis. So what that means is if I move $100 billion of Tether as a business, I count that all as revenue. So that is a real friction in terms of payment businesses absorbing this, because even as the biggest payment companies in the world, say with $5, $10 billion a year of revenue per quarter, if you now have a revenue line item of $100 billion revenue, but you're making, say, 5, 10 bips on that, that completely destroys your revenue margin profile. So there's a lot of work that's being done. It definitely has helped solve some of the key points around trust and the perception of stablecoins and the acceptability of stablecoins. But there are still the nitty-gritty details that need to be resolved in terms of rulemaking, where I know that we've all contributed to that. But secondly, also, in terms of some of the less sexy pieces around FASB and the way that these things are accounted for, really, really matters.
Yeah, just to add to what Ed is saying, I mean, eventually this is right now a US effort, a US-centric effort, but eventually it needs to be harmonized globally, right? Because most of the flows that we see right now with stablecoins are cross-border, right? So the same treatment across compliance, accounting, safety and soundness, and so on, it needs to be harmonized globally, and right now that's an additional friction point that we are seeing.
Yeah.
I will say I think a lot of people are looking to the US and then informing their decision making based on what the US is doing, which is good. And I would say directionally a lot of what is happening on the rulemaking side in the US is positive, right? And sort of the spectrum of outcomes, it's leaning towards better versus worse. So that's all, I think, things that we're all excited about.
Yeah, this is a point in time where the world is basically deciding whether the cars are going to drive on the right or the left side of the road, or whether the plugs are going to have a certain shape, or the voltage on the outlets are going to be 110 or 220 volts. Another analogy I like to make to explain how complex the system is rail gauges. So the distance between the two rail bars that stay under the trains, it's not homogeneous around the world and has to be harmonized, right? And especially if you want trains to be crossing borders effectively, and you don't want to to transfer goods from one train to the other every time you need to cross a border. So this is a moment where global regulators are very actively looking at what's happening with rulemaking and Genius, and subsequently Clarity in the next 12, 18 months, and understanding exactly how to shape their own local domestic regulatory framework so that the gauges for the railway match those that are in the US, which is still power projecting the dollar as its finest tool of geopolitics. And it has been successful for 100 years, and it will be probably for the next 100 years. So we are really building at Anchorage Digital and all the builders on stage. I'm sure we're all building towards this future that is anywhere between 12 to 18 months out, where we try to see the homogeneous, harmonized landscape flowing very freely.
So Sergio, you're like on the FCA side or the French central bank side?
Well, I don't know what the Italian central bank is doing these days. I've been out for a while, but definitely it's time for updates on that front, I would say, on the regulatory front. In fact, I think the ECB now is in a quiet period pending some updates, which are most welcome. I think that it's really good to see regulators actually working towards building a framework that makes money flow better.
So shifting to the political and competitive tension between banks and stablecoin issuers, Nick, for the yield debate. Is the banking industry's opposition to stablecoin yield a genuine concern about systemic risk, or is it simply a protectionist competition to designed to prevent deposit flight?
Yeah, I like it. I get the spicy one. It's 100% about it's anti-competitive behavior, right? Stablecoins are effectively over-regulated money market funds, of which there's 7 trillion, in assets today, right? And so, and banks' business of lending is inherently riskier than parking all your money at the Fed or in short-dated U.S. Treasury bills. So I think they really love the right capture of, I can give a consumer or a business 200 basis points, and I can park it in the Fed overnight and make that spread, right? And I think they're worried that, stablecoin issuers or folks that are involved in rewards are going to, make them, offer a more competitive product, right? Or you build a competitive product. And so I think it's 100% just anti-competitive behavior.
If I can actually give my 2 cents over there,
Yeah.
It is like a combination. Well, I think the world of banking executives right now is split between people that kind of don't fully understand this, the nuance over there, and people that actually understand and they're deliberately acting in an anti-competitive way. Because the reality is that assuming that the world actually moves on-chain, it doesn't matter. The current business model of the banks is cooked, because if I'm able to be, whether it's like, stablecoin or tokenized deposit, and instantaneously I can switch to a tokenized money market fund, right? And the only thing that I'm paying is, I don't know, whatever Ed is charging us over there, like, from a basis point standpoint, and some fees to Solana or Ethereum or whatever, right? And it's being done autonomously by some kind of, just like, an automatic sweep that happens all the time. There won't be deposits, right? That's the truth. Yeah. Like, why would I give my money to the bank to lend it on the other side as an individual, as a business, as a consumer, right? They need to think about a different business model, and I think there is a bigger macro question of how private credit is going to be originated, but in an on-chain world, we are not going to see it. And by the way, there is something to say that it's not like even specific to stablecoins or blockchain. I think what we've seen with Silicon Valley Bank was some form of that artifact that, like, that when the system is instantaneous, okay, the traditional banking world of fractional reserve doesn't work.
And I think also, like, I love competition. Like, they need to offer more competitive rates, right? It's like, if you're going to give the bank your money, right, they should be giving you 5% or 6%, right, to compensate you for the risk.
Yeah.
And today, and really since like the GFC, like, consumers and most businesses, unless they have power over, economies of scale power over the banks, have been totally getting hosed.
I just think, I didn't wear a suit today to defend the banks, but I think I do think it's an important.
You dressed the part.
I think it's an important nuance that we need to articulate. So, stablecoins, for a lot of people, I view it as a big value proposition around value in motion as opposed to value at rest. So objectively, if you can have a US account today, I think most US people will decide to have actually $1 at rest, in the sense that it's FDIC insured, there's a ton of nuances and differences. I do think that there is definitely an important aspect between interoperability of money. And so the ability to move to a yield-bearing instrument, whether that be just a classic dollar or, for example, instruments that you've helped create, that's also really important. So stablecoins are a really powerful alternative payment method. And if you want to hold it at rest, it's quite simple. You can simply just convert it into a yield-bearing instrument. I do also think there's something that's missed as well in this discussion about yield. The way that the legislation under Genius has been created, it is functionally, if banks and stablecoin issuers were to get into a competition around yield, the banks are ultimately going to win. And this is simply why. The way that the reserves work under Genius is that the majority of that needs to be held in tokenized money, in terms of money market funds. You are never, ever going to be able to compete with a fractional reserve banking system in terms of yield. And so this argument that you get into this debate, I just think is relatively a moot point. And I think stablecoin issuers and people that act in stablecoin space need to talk about utility beyond just yield. because I think that that is frankly the wrong use case for most stablecoin applications, which is a transactional business as opposed to an asset at rest business. And if you want to create an asset at rest business in a tokenized way, then just use a tokenized yield-bearing instrument.
Yeah, and back to my previous point, what we need to see is where the situation will materialize in 24 months, when trillions of dollars will re-platform on-chain, and at that point, most of the Genius compliant stablecoins will be backed partially by deposits and tokenized deposits, and there you go. The deposits are actually going somewhere, and they're not flying into the ether. No pun intended. They're going, they're going to be backing stablecoins, and this interoperability is very important. So what we have to do today is building the foundations that enable interoperability. Yesterday we announced a partnership with JP Morgan where we enable cashless reserves for the stablecoins issued by Anchorage Digital Bank, and this is exactly to our point, a testament to the fact that when you have the right components for interoperability, when you have abstraction from bank balance sheet in a stablecoin reserve, but also the ability to do 24/7 redemption onto Fiat at a GSIB, then you really abstract away from anything that would be in an old school stablecoin would be considered liquidity risk, would be considered exposure to banks, would be potential depegging. We take it all away and we just work with the biggest global banks to build the interoperability at the base layer. And then the stablecoin builders go and distribute the stablecoin on top without any deposit flight even in the conversation.
Yeah,
So I don't want to cut you guys off, but we have only about a minute.
No,
30
we're in the
left.
midst of it.
No, I know, I like it. I wish we had more.
Well, quickly, what I'll just say is like a lot of the stablecoin issuers are very complementary to the banks. To Sergio's point, like we're a globally liquid stablecoin. We need banking partners, right?
Yeah.
And you're giving them deposits, so it is like it can be a very complementary relationship.
But so for my final question, which we only have 1 minute for each of you to answer, yes or no, in like looking ahead, will the bigger companies like Visa and MasterCard, will they successfully integrate stablecoins into their settlement layers, or will ultimately a blockchain native company win?
Absolutely, they are doing it today. They've made already announcements, and again, our cashless. Actually, yes, they are using stablecoins. They're not staying away and seeing it as a competitive factor. They see it as a fantastic new augmentation of their existing network. Their networks were built on decades of adding nodes and adding utilities. So that's not going anywhere. That's staying, and now they're augmenting it with stablecoins. And cashless reserves are one of the many components that allow them to do it safely with the comfort that they don't have to face any question about liquidity.
10 seconds. Michael,
yes
or no?
Yes, short term, the main question is like, what will happen once it will start touching the moats around their main business? Okay. Which is not yet the case.
And I'll just say yes, and like their business, right, they're a payments company, but their main business is pricing risk, right, which none of us do.
Edward, final word.
Maybe at risk of being boring, yes. And a lot of their business is around interoperability of payment networks around the world, and stablecoins, in my mind, are no different in terms of being another massively powerful payment method.
Okay. Thank you all very much for taking the time. Thank you for being an active audience.